the flexibility associated with having too much property can be quite limiting.
Yeah. Yep.
And one of the considerations is, if you're deploying this strategy, make sure that you're also not just so focused on property. Make sure that you're also investing in superannuation that's going to be a tax-free asset when you retire. Make sure that you're also investing in alternative asset classes like shares, like bonds, like infrastructure that have their own benefits along your investing journey as well.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are again. We're in the same recording studio that we were in last week, but all of a sudden we've changed our location a little bit. We've changed our orientation, and hopefully that gives our viewers a little bit more to see other than just the white wall that was behind us.
And we've got a bit creative too. There's a TV on the screen behind us. We've got our logo on there. So
Exactly right.
Look at us increasing the podcast production for our listeners and our viewers. So hopefully they appreciate that a little bit. But Andrew, it is a podcast, so most people are probably listening to this. Let's talk to everybody about what we're talking about today.
Yeah, absolutely. So today we're talking about a topic that I really like, just because it's an interesting topic. And it's something that, divides opinion. And what we're talking about is rentvesting.
Rentvesting.
Yes,
I love the name.
Billy, you got your athlete's water bottle.
I'm an athlete now, Andrew.
We're going on a lot of tangents this morning. We need to focus, I think. Tell us, Billy, what is rentvesting?
Rentvesting is where you intentionally decide to rent your owner-occupier, and you still want to get into the property market, but you do it as an investor as opposed to an owner-occupier. So we'll talk through the pros, the cons. We'll talk a little bit about why it's sort of come about. I'm really fond of not necessarily this topic per se, but anything that helps people solve a problem. I'm really fascinated by it. And I think one of the problems that we've got, at least in Australia and in our capital cities as well too, is that housing has become very, very expensive, and trying to get into the property market in particular is quite a challenge. I mean, not only do you need your deposit, you need a certain level of serviceability, all the while house prices or property prices are increasing. So looking at rentvesting as an alternative to try and help people get property under their belt in terms of, acquiring assets and building wealth, I think it's a great topic, and I think it's really timely considering what we're experiencing in Australia at the moment. We're seeing record levels of migration. We're seeing the rental crisis. All you need to do is drive around on a Saturday morning, look at some open for inspections, and there's absolutely lines down the street. So I think it's a really topical or timely topic, and looking forward to getting into it.
Yeah, absolutely. Look, I think when you go to some of the benefits that come out of rentvesting, my mind tends to go to, really the benefit of getting almost the best of both worlds. Mm-hmm. So a lot of the times when you're talking to people that are purchasing, whether it's their first property, second property, third property, it's really easy to get emotional. You really like this kitchen, the layout, you really like, X, Y, Z in a property, and it's the decision is based off the intangible things that you would like to see in a property, but not necessarily the tangible things that will deliver the best rate of return for that property. And one of the benefits out of rentvesting is you have the ability to do both. Yeah. So where you live doesn't necessarily or has no bearing whatsoever on an investment decision-making process. So where you live is purely just a lifestyle choice. It's based off the rent that you're going to pay and based off, obviously, the area and the property that you want to live in. And where you invest is purely an investment decision. Mm-hmm. All you're looking at is this property going to deliver the investment returns and what I would like to see out of that property? Is it a capital growth asset? Is it an income asset? What's the purpose of this property? And is it going to help facilitate my wealth creation goals? And so one of the big benefits and one of the things that people really like about rentvesting is you don't need to balance both of those things out, which you otherwise would need to do in a traditional approach of buying a property and living in a property.
Ticking those two boxes where it meets your lifestyle requirements and the requirements that you need for it to stack up as an investment is really hard to do.
Yeah.
And the other thing too that I want to sort of highlight is if you think about, even your own journey, Andrew, or my own journey, when Sam and I were together without kids, our lifestyle was completely different. That we didn't do this, but living somewhere where maybe in an apartment complex that had some facilities that was close to, inner city, whatever it is, to match our lifestyle.
Yeah.
And then as and when, things changed, we had kids, we want a bit more room, we need some more storage, we like access to parks, all that sort of stuff. Then you move out into the burbs, in that instance. That would have been a really great thing to experience because we kind of get to choose the best of both worlds and move our accommodation in line. And it's not as easy as what you're saying, but moving from one rental to the next is definitely easier than buying and selling.
Yeah.
That would have worked out quite well. So balancing the two between the investment stacking up and it matching your lifestyle is very difficult to tick both of those boxes in one go. So I really like the concept of this.
Yeah. And the other thing to consider is, you can do it. Sort of, you alluded to it, and you can purchase a property, live in the property, sell and purchase another property. But it does raise some complexity with it and time, effort and energy because you need to go through the sale process. But assuming that there aren't any, because you're only going to get it once, assuming that, and it can only be within certain price brackets and all of that stuff. So assuming that you're not looking at any first home buyer schemes where you're saving on stamp duty or anything like that, the cost of purchasing another property and selling a property, by the time you take agent fees, by the time you take marketing, by the time you take stamp duty on the new property, is massive. And so you make a lifestyle choice and you're probably only going to do it maybe a couple of times because you're not wanting to incur those costs along the way. Versus when you're rentvesting, if you want to change your lifestyle, it's a very simple and easy process. You don't renew the lease, you move into another property, and maybe there's some moving costs that are associated with it and paying a bond, which you refund from one and pay to another. So the ease in which you can change your lifestyle is significantly easier, and you're still getting the benefits of investing in property and investing in asset class that a lot of Australians love and is a great asset class to invest in.
Yeah. One of the things that comes to mind for me, going back to that example of potentially living in an apartment complex or what have you, is, and I'm using apartments in particular for this point that I want to try and make, but a lot of the apartments that are going up are adding so many different things to make the building attractive. Cinema rooms, libraries, rooftop bars, gymnasiums, pools. Love the idea from a lifestyle perspective, but paying for the body corporate associated with those, I love the idea of making that someone else's problem.
Yeah, exactly.
So if you're the tenant, you can benefit off all of those things without having to incur the costs of running such expensive amenities. But that's that sort of ties into my next point about repairs and maintenance. So if you're the owner-occupier, you're responsible for paying for the repairs and maintenance, whereas if you're renting, that goes to the managing agent, assuming that there is one, and then they hit up the owner, and the owner pays for it, basically.
Yeah.
So there's a lot of flexibility, a lot less maintenance as well too, because if anything goes wrong, it's essentially someone else's responsibility.
Yeah, exactly right. And so what you could do in that theoretical example is live in the type of property that meets the lifestyle, not incur the body corporate, the maintenance and all of that stuff. And then when you're investing in property, avoid those assets that are going to incur those costs and invest in, a house. In the other thing that a lot of people don't consider is you broaden your scope when you're looking at properties. So ordinarily speaking, when you're looking at property, you generally restricted to your own geographical location, whereas when people are rentvesting, your scope of investments or your scope of assets that you're going to purchase is no longer just in the area that you're living in and in the area that you want to live in, but now all of a sudden is realistically anywhere around Australia.
Yeah, no, love it. Love that idea. Andrew, we can't go past this one. Everybody loves to pay less tax.
Absolutely.
The tax advantages of having a property, this is the same as what we've spoken about when you're just generally investing as well, in terms of negatively geared and being able to claim a deductibility on the interest that you pay. So that's the same. That's no different in this particular context. I guess that the only difference that we want to highlight is that you're renting over here. So your property that you do own is an investment property. So in the event where you are negatively geared, you can claim the tax deductibility of the interest that you end up paying.
Yeah, exactly right. And so realistically, what that means is that all of your debt is deductible. So you only have good debt, assuming this scenario. You don't actually have any of the bad debt. You don't actually have any debt where you need to, look at things like a debt recycling strategy to convert your debt over from, non-deductible to deductible. You have all of your debt as non-deductible. Well, sorry, you have all of your debt as deductible debt. Let's make a flip over to maybe some of the cons associated with a rent vesting strategy. What are some of the negative impacts of that?
The first one that springs to mind for me is that, and we spoke about last week's episode about the rental crisis and bits and pieces like that. But if you think about the security that you have in your owner occupier, essentially, as long as you don't muck up and the bank take the property and repossess it, that's your home. Nobody can kick you out. Whereas from a rental perspective, if the owner wants that property back because they want to move in or they're selling it or what have you, then away you go, right? They can do that. That also ties into the costs associated with the rent. There's a little bit of a question mark in terms of how much rent you're paying this year versus next year and so on and so forth. So I think just from a security perspective, depending on what that looks like, that could be critical. For somebody, you may have an affliction towards, not really caring whether or not that's the case. I may be completely opposite. And I tend to think that as you get older, you want more security because you have less, resources to be able to handle and manage that. So as you get older, is renting a bigger issue for you when you're older than when you're younger. So I think the security piece around the property that you live in can't be understated. I'd definitely put that in the cons column associated with rent vesting.
Yeah, absolutely. I think one of the things that you also touched on as well is some of the other costs that are associated with it. So if you're rent vesting, then all of your properties essentially are investment properties. Mm-hmm. So land tax is a really big one. Yep. And it's a topical issue because we've seen land tax in Victoria increase quite dramatically from one year to the next. And as a result of it, if you consider someone that, might have multiple investment properties, that has a very significant impact to your budget, has a very significant impact to whether that's now a feasible investment or not. Mm-hmm. And so when you're then also throwing into the mix that there's repairs, there's maintenance, there's all of that stuff that needs to come into a property, and you multiply that out across multiple properties, then all of a sudden it can become quite an expensive exercise to hold multiple properties. And it's difficult with any degree of certainty to pinpoint exactly how much that's going to be. Land tax, yes, okay, you can estimate that over the course of maybe the next 12 months, but changes in legislation will have an impact to it. There's obviously also the fact that, if there's a mortgage, which for most people there is, if there's a mortgage associated with it, you're also impacted by potential rising interest rates. If there's also multiple properties that need multiple repairs, that need multiple, it can become an expensive exercise. And sometimes not even just the expense. The expense is one thing, whether it's a feasible investment, but I have seen clients get to the point where they own multiple properties and they completely change their mentality and want to liquidate their properties, not because the expense has become expensive in the form of money, but in the form of time.
Yeah.
needing to coordinate trades, needing to think about, okay, something is always happening all of the time. There's an issue with one tenant and I need to do something in order to repair the property, to maintain the property and keep it in, tenable condition.
Mm-hmm. Yeah, no. And look, I tend to think that tends to happen. So the simplicity aspect tends to happen as you get a little bit, this is a gross generalization here, but it tends to happen as you get older as well too. So I think that as you progress along this journey, if you do have multiple properties, there is a tendency towards simplification. But what you referred to before, Andrew, I think cash flow is a huge one. So not only cash flow to manage the property portfolio per se, but also having the cash to be able to, assuming that you're negatively geared, service the investment property that you're rent vesting, and then also having the money to be able to rent as well too. I mean, you're talking about some cash flow implications here to make this whole thing work.
Yeah, absolutely.
And that can't be downplayed. And then you go and stack on top all of those things that you were talking about, land tax and repairs and maintenance and bits and pieces, making sure that you've got strong cash flow modelling, I think, and then obviously all of the stuff that sits around that, savings, emergency liquidity funds, if you've got stable employment, some leave accrued. I think all of those things start ticking those boxes for me, but it can't be downplayed that cash flow, in order to make this strategy successful and for someone to consider it, cash flow is a really big implication that sits at the centre of this. And I think, once again, we can put that in the cons column because that's something that you need to solve for if you're figuring out whether or not this is right for you.
Yeah, exactly. And I think when you're talking about rent vesting and when you're talking about cash flow that's associated with it, I tend to see people that deploy a rent vesting strategy tend to have a very big focus around property, and they really tend to have an affinity around property, which can be an area of concern and can actually derail your strategy at some point in time. Properties, residential property particularly in Victoria or even in Australia, tends to have lower yields. So what you tend to see is have someone that has a really high asset value but very limited cash flow. And that's fine and that's okay while you're working, while you're generating an income. But as you start to approach retirement phase, it doesn't match up. Like to have, $2 or $3 million worth of assets and to have, rental income that might be coming in of, $60,000 or $70,000 a year net is not comparable to having that money invested in another asset class, which gives you the flexibility to be able to draw down on some of the capital if you need the capital, to be able to have flexibility when you're in the retirement phase of your investing journey. And so the flexibility associated with having too much property can be quite limiting. And one of the considerations is if you're deploying this strategy, make sure that you're also not just so focused on property. Make sure that you're also investing in superannuation that's going to be a tax-free asset when you retire. Make sure that you're also investing in alternative asset classes like shares, like bonds, like infrastructure that have their own benefits along your investing journey as well.
So what you're suggesting is get advice.
Exactly right. We're jumping to the end of the podcast, but I think that the big key takeaway is make sure that if you're doing whichever strategy you're deploying, make sure that there's an actual strategy behind it.
I think that's critical. One of the really big things, so with owner-occupier, when you sell the property, the property is exempt from capital gains tax. Obviously, that's not the case if you've got an investment property. So that can't be understated in the grand scheme of things as well too, because at some point in time, you may end up selling the property that you used as the investment in the rent vesting strategy. The CGT exemption is huge. So essentially on any owner-occupier property, if you've occupied it for all of the time, there are some nuances around that, but essentially anything that you experience from a capital gain perspective, there is zero tax on that. Whereas, if it's an investment property as part of a rent vesting strategy, if you've made a gain, you will pay capital gains tax on that property at your applicable marginal tax rate. So depending on what you're earning at that particular year, when you do incur the capital gain, there could be some fairly significant tax implications associated with it in the form of capital gains tax.
Yeah, and that's that's massive. I mean, you can't downplay how big that is in a strategy. And there isn't a really funky word for it, so maybe we'll create one. But I've got a client, and their entire strategy is own vesting. That's what I'm going to call it. I'm going to coin it as own vesting. Let's copyright that one. Maybe there is a term and I just don't know it. But their entire strategy is around buying a property that they live in. Yeah. Now, they're in a fortunate position, and I do think that anyone can do this strategy, provided that you're obviously getting the right advice. But they're in a fortunate position where the wife is an interior designer, the husband is a carpenter, and so they've got a pretty big know-how in terms of renovating and fixing up properties. But what they do is buy a property, live in the property, fix the property up while they're living in it. So, they might be doing, or they might have periods of time where they don't have access to a fully functioning kitchen and all of that stuff. So it impacts their lifestyle. But they'll fix up a property, make a profit, sell, go into the next owner-occupied property. Because it's an owner-occupied property, they're in essence not paying any capital gains tax that's associated with that property. So maybe on the flip side, when you're talking about rent vesting, there's also own vesting where you look at, live in the property, add value to it, on-sell it, and not need to pay any capital gains tax as a result, as a potential flip side or potential alternative strategy as well.
We might just pay homage to our accounting mates with this one as well too, because if it is deemed that it's run like a business, then it's taxed differently. So I'd say on that one, if that's something that you're doing or considering doing, definitely get tax advice first, because if that's the case, depending on where that line is, we don't know what that is. It could be seen.
You can't do it 5 times a year.
Well, it could be seen. I mean, if you could do it 5 times a year, I don't know how you've got the time, energy, and effort to do it, but that's a different story. But it could be seen that it is for gain or income producing purposes. The ATO will treat it differently.
Absolutely.
So, and probably the last thing on my list, Andrew, in terms of some of the disadvantages of rest renting, just to take a balanced approach, is you don't get any of the exemptions that you'd get as a first homeowner trying to get into property, because the whole idea is that all of the incentives that are around are really designed to try and help people get into their first owner-occupier premises.
Yeah, exactly. So your reduction in stamp duty, all of that stuff is not applicable to you if it's an investment property.
Yep.
And so another thing to consider is if you're going down a rent vesting strategy, the first property that you purchase is essentially going to wipe you out if it's an investment property from any first home buyer benefits in the future for you or your partner. So one of the questions in the first home buyer scheme is, have you or your partner owned the property? And so some of the considerations with that is, do you buy an owner-occupied property first, live in it for a period of time, and then convert it to an investment property and move into a rent vesting strategy? But I guess it all comes down to what's your strategy, get advice, and make sure that it's ultimately right for you.
Yeah, and I mean, look, that's always the case, and I think like anything, and like I said at the top of the show as well too, I think this is quite an exciting opportunity to be able to look at, I guess, something that's a bit alternative to, I guess, the traditional route of, saving up, buying a property, living in it, upgrading and doing that and the like. I'm excited by it. I think like anything, you need to have a strategy, because I think once you go down this path, that kind of sets the trajectory that you're on. Not saying that that's right or wrong, but getting some advice and getting somebody to help you work through that, I think, is absolutely critical. Andrew, I think we did this one justice.
Absolutely. Thanks very much, Bills.
Yeah. To our listeners, to our viewers, hopefully you got a whole heap of value out of that. As always, reach out if you want any further information, like and subscribe, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.